Welcome to Bookkeeping Concepts Made Simple, in which we take individual bookkeeping concepts and discuss them with the idea that understanding is a faster way to competence than just memorization. And today, in this video, I want to talk about the queen mother of all bookkeeping concepts, the most important concept in bookkeeping, the fundamental concept upon which everything else is built, and that's debits and credits. Now, bookkeeping is properly called double entry bookkeeping, And the reason it's so named is because double entry bookkeeping answers two critical questions about every business transaction. The questions are, where did it come from and where did it go? So for example, if your company sells something for $100, the $100 came from sales, and if you put the $100 in a bank, the $100 went to a bank. If you took the money out of the bank and paid an expense, it came from the bank and paid and went to an expense. If you borrow money from a credit card to buy inventory, the money came from a credit card and went to inventory. Every leg of every business transaction has two parts. Where did it come from and where did it go? That's what double entry bookkeeping was created to account for. So what about debits and credits? Well, the fascinating history of bookkeeping is that it was first popularized in 1494 by a Venetian monk named Luca Pacioli. And bookkeeping had in fact been around about 200 years before that. But at that time, the language of business, language of science and academia and art was Latin. So the people who created this system, who created double entry bookkeeping, were searching for terms to describe where did it come from and where did it go. And the terms that they came up with were debit and credit. Credit literally is a Latin word that means to trust. Debit is a Latin word that means to owe. So the account that brought the money in and is going somewhere else trusts that the account that it goes to will account for the money, the transaction. The account that received it owes an accounting. So where the transaction originated, where it comes from, gets the credit, and the account where it went gets the debit. Okay? So a lot of us might have learned by memorization that this type of account has this kind of balance and this type of account has that kind of a balance. And it's generally true. For example, liability accounts, equity accounts, and income generally have credit balances. Expense accounts and asset accounts generally have debit balances, and that makes sense. That's consistent with the founder's philosophy, because there are three ways for money to get into a business. You can borrow it from somebody else, which is a liability. You can put it in yourself as an owner. You can pay into your business, that's equity. Or you can sell something, which is sales. Those are the three ways. As far as I think I'm right in this, that's the only three ways that money can enter a business. The money is then generally spent to buy assets or to pay expenses in order to do operations and make a profit. So it's consistent. Liabilities, equity, and income have credit balances because they're the from source, and assets and expenses generally have debit balances because they're the to source, they're the where it went. Now the problem with memorization is this: any of those accounts can have a debit or a credit balance. Now what am I talking about? A bank account is an asset. It's something you own, and it generally has a debit balance. But what happens if you overdraw that account? If you take out more to pay expenses than you had in there, all of a sudden it had a credit account, a credit balance. Well, people sitting around thinking, wait a minute, debits increase assets and credits decrease assets, but credits increase liability. Don't think about all that stuff. You don't have to think about all that. You don't have to do it by memory or rote. All you have to do is remember that where it came from gets the credit, it trusts, and where it goes has the debit, it owes. And what it trusts and what it owes is an accounting which is recorded as money, which represents the value of what happened to the company. So if you like these tips, please subscribe to my channel. We'll be doing more over the next coming months. And if you would like to get in a hurry, check out my book, The Profit Problem. They say I make money, so why don't I have any? And in that, you'll find the concepts that we're talking about in these videos, but I take it a step further. And if you're a bookkeeper, what I'm showing you is how to teach your business clients to use financial information to make better decisions and more money. It's staggering the amount of decisions that you can make informed rather than just by gut feel. So check it out, check out my book, and subscribe to the channel.